Look at this chart, looking at the performance of the US stock market if you bought and sold your investments over different periods at any point between 1926 to 2016. What you'd find is that if you bought and held your investments for just one day, at any point, the probability that you would have made money is just 55%. That's about a coin flip. But if you bought and you held your investments for at least 1 month at any point during that period, now the probability that you make money is now 62%. That's much better. And if you held your investments for 1 year, the probability that you would have made money is 74%. And if you're a long-term investor and held for at least 4 years, probability that you would have made money is now 92%, which in my view is pretty high. In other words, the longer you hold, the lower the risk. That's because the longer you hold the investment, the more you smooth out daily volatility and reduce time risk, that is, the risk of buying in the wrong time. Check out this next chart showing you the rolling 30-year returns of the US stock market. And there we can see that the worst 30-year performance of the US stock market was 8.2% annually. And that would be if you invested in the worst possible time, that is in 1929, just before the start of the Great Depression, where you would have seen US stock market slide by over 90% over the course of the next 3 years. You would have seen massive unemployment, and you would also have seen US economic output get cut in half. It was a really bad time for the United States and the world, and a specifically bad time for investors. But if you held your investments and waited another 27 years, your investments would have recovered and you'd be averaging about 8.2% annually. Not bad for the worst time to invest in US history. And there lies the importance of investing for the long term. Investing is like planting a tree. You won't see results overnight, and sometimes a storm will come and blow away all of your hard work. But the growth is there, the roots are growing, and that's what matters. So why do people think the stock market is risky? There are 2 reasons there. Number 1 is they have a short-term horizon. Yes, if you buy a random stock today and sell tomorrow, there is a 45% chance you'll be losing money. But that is not investing. If you buy and hold for a day, that is just speculation. That's very different. And that is more akin to gambling than investing. But if you wait 4 years, now you only have a 7% chance of loss historically. Now this 92 to 93% probability of winning is pretty high. Imagine if you could buy a lottery ticket with a 92% probability of winning. How many would you buy? Second reason why people think the stock market is risky is this. They tend to adopt the wrong strategy. If you buy individual stocks, there is a chance that you could lose 100% of the money you invested if the company goes bankrupt. That is why we probably shouldn't be doing that, because that is not the optimal way to invest. If that happens to you, it's understandable why you think the stock market is risky. But that belief is not grounded in evidence. If you invest wrong, you can expect to lose money. But that's a topic for another video. I'm Anthony Walsh, a qualified financial advisor and personal finance author. And this was why the stock market is not as risky as you think.